Winnebago Industries, a well-known name in the American recreational vehicle market, has sent ripples through the investor community after releasing its preliminary third-quarter results for fiscal 2025. The results, which came ahead of the company's appearance at the Baird 2025 Global Consumer Technology and Services Conference, fell significantly short of analyst expectations. As a result, the company's stock took a sharp hit, dropping nearly 7% in a single day and continuing a downward trend that has seen the stock lose over 30% of its value this year. According to the press release, Winnebago expects to report net revenues of approximately $775 million for the quarter ending May 31st. This is notably lower than the $799.6 million forecasted by analysts surveyed by Visible Alpha. Moreover, the company estimates its reported earnings per diluted share to fall between 55 cents and 65 cents, while adjusted diluted earnings per share are expected to land in the range of 75 cents to 85 cents. These figures contrast sharply with analyst expectations of $1.16 for earnings per share and $1.28 for adjusted EPS. The shortfall reflects deeper challenges in the market for motorhomes, and the company's reaction points to an urgent need to recalibrate operations in response to changing demand dynamics. Winnebago's CEO Michael Happe offered context behind the disappointing numbers, painting a picture of a selling season that began with promise but was quickly derailed. March started off strong, but the positive momentum failed to carry through the entire quarter. Happe noted that broader macroeconomic uncertainty became more pronounced in the final 2 months of the fiscal third quarter, negatively impacting consumer sentiment. Dealers, wary of growing inventory and economic signals, grew increasingly cautious, which affected order flow and overall demand. These factors combined to create a difficult environment for RV sales, particularly in the motorhome segment. In response to this shift in demand, the company has made it clear that it will be taking immediate and aggressive action to realign production with market realities. Specifically, Winnebago is aggressively modifying production schedules and adjusting headcount, signaling potential layoffs or reduced labor hours as part of a broader cost-cutting effort. These changes are part of a larger strategic initiative aimed at improving profitability and efficiency throughout the rest of fiscal 2025 and heading into fiscal 2026. The company's emphasis on vigilant inventory management is also telling. Rather than continuing to produce at previous levels and risk overwhelming their dealer network with unsold inventory, Winnebago is choosing to pull back. This strategy may help preserve long-term profitability and reduce unnecessary costs, but it comes at the expense of short-term revenue growth and operational stability. Still, this kind of disciplined response could position the company more favorably when market conditions improve. From a broader perspective, Winnebago's performance serves as a reflection of the current economic climate in the United States. As inflationary pressures linger, interest rates remain elevated, and consumer confidence fluctuates, discretionary spending on big-ticket items, like recreational vehicles, is naturally affected. While the RV industry often thrives during times of strong economic optimism and low financing costs, it is especially vulnerable during uncertain periods. Many potential buyers are likely holding off on such purchases until there is more clarity about the economy's trajectory. Furthermore, dealers themselves play a significant role in shaping the market landscape. When dealers are hesitant to take on new inventory, it creates a ripple effect throughout the supply chain. Manufacturers like Winnebago have to slow production, which then affects employment, earnings, and investor confidence. This is exactly the scenario unfolding now, and it highlights how interconnected the entire RV ecosystem truly is. Investors have responded swiftly to this news, with the stock's decline indicating a strong reaction to the lowered guidance and outlook. A nearly 7% drop in one day suggests that many in the market were caught off guard by the depth of the challenges Winnebago is facing. While some of this may have been priced in over the past few months, the latest figures provided more clarity and more concern than previously expected. Still, for long-term investors, there may be a silver lining. If Winnebago's leadership is able to successfully implement the cost-cutting measures and navigate the current headwinds, the company could emerge stronger and more resilient. Additionally, when the broader economic environment stabilizes, there could be a resurgence in demand for recreational vehicles, especially as travel trends continue to favor domestic and road-based tourism. That said, risks remain. The competitive landscape in the RV industry is intense, and any extended period of weak demand could put smaller or less efficient players under serious pressure. Winnebago, with its established brand and relatively strong balance sheet, may be better positioned than most, but it will still need to execute its strategic adjustments flawlessly. As with any publicly traded company, investors and analysts will be closely watching Winnebago's next earnings release to see how the final numbers compare to the preliminary estimates. They'll also be listening for commentary on order trends, dealer sentiment, inventory levels, and any changes in cost structures. The next few months could be critical in shaping the company's financial narrative going forward. In the meantime, anyone who owns a Winnebago vehicle, works in the industry, or invests in the RV sector should stay informed and prepared for continued volatility. The recreational vehicle market, like many sectors tied to consumer confidence and discretionary spending, is facing a moment of correction. How companies like Winnebago respond now will determine their strength in the recovery phase. For those seeking deeper insights or smarter tools to track market shifts and company performance, platforms like HIX.AI Chat offer powerful alternatives to traditional research, giving users access to real-time updates, smart summaries, and investment research capabilities that can help them stay one step ahead.